Hey, what's up everybody? This is Kip Johnson and Casey Carpenter here for another video. It's been a while. We've had some changes. I just switched over to Keller Williams Portland Elite, and I can't wait to bring just some awesome content to you. But today, me and Casey are going to talk about something that you will be able to go and purchase a home still with record low rates. So the way you can still purchase a home with record low rates is by finding a home with an assumable loan. The reason I have Casey here today is to kind of tell us what those assumable loans are. So Casey, how does the assumable loan program kind of work?
Yeah, absolutely. And I think it's a great topic to kind of bring up, Kip, as you know. I mean, everybody knows the market's been a different market, higher rates and stuff like that makes it really hard for people to afford a mortgage payment. It makes them hard to purchase a house, right? So assumable loan is essentially a loan that can be assumed by a buyer. It can be a seller's loan that they have on that property that a buyer can walk in and assume that mortgage. This really works, on FHA loans, on VA loans are kind of the primary ones that you see that are assumable. But really, I mean, there's some other options out there too. You just have to check with that servicing or that lender that has the loan to see if it's assumable. But primarily, you're seeing it on FHA and VA loans. There could be some conventionals out there too, but you kind of see it on those government loans.
So right now, let's say that what our interest rates right now, 7%.
Yeah,
6.75.
Yeah,
but you're saying that I can go still buy a house with a 2.75 loan if that loan was already in place by the last owner.
Absolutely. I mean, that's the killer part about it. So most people probably, did a purchase or did a refinance there in 2020, 2021, got a killer interest rate on it, 2.5%, 3%, 2.25%, super low interest rates, which we're just not seeing. We haven't seen them a year and a half, right? And so imagine that. Imagine a payment at 2.5% versus someone trying to qualify right now at 7%. I mean, that's 2 or 3 times higher, right?
So let's say it's a $500,000 house. I know you don't have your calculator on you, but like just ballpark, kind of how much would that monthly payment, how much would you save on going from a 7% loan interest rate to a 3% interest rate?
Yeah, I'd say you're going to save at least probably a couple grand in payment, right? No problem.
Right.
Like you might be looking from a $3,500 payment to like a $1,500 payment. Huge. So assumable loans out there, like, they're great. Buyers can step in and get these little payments, but it's not like they're advertising.
Dude, daddy daycare in full effect. Kids trying to sneak to get some candy.
Well, that's a good, it's a good example, right? It's like this mystery house out there. As a buyer, when you're online, it's not like you see like it listed like in your face, a Redfin or whatever they're looking at online, like assumable loan. So it's like, Kip, how do you find these houses that have assumable loans?
Yeah, it's not like, you're seeing like, hey, this house has a FHA, it qualifies for an FHA loan, it qualifies for a VA loan, it qualifies for a conventional loan, and it's an assumable loan. They have an assumable loan.
Right.
So me as a listing agent, like it's my responsibility to have my clients go ahead and reach out to their loan originators or whoever holds their loan at the time. And I have my clients reach out to them and see if their loan is assumable. Because not all loans are assumable. Not FHA loans, not all FHA loans are assumable, not all VA loans are assumable, but some are. So I have my clients reach out, find out if there's assumable. If it is, I put it in the descriptions, right?
Yeah.
So we have a private remarks description that only us real estate agents can see, and then I also have a public remarks description. So I'll put it in both so that people can search specifically for that.
Yeah, so the agents can see it in the privates. You got the public, so the buyers can see it if you're sending them our
But all the agents don't know about it.
Totally.
A bunch of the agents don't really know what the assumable loan is or kind of how it works. So with that, let's get back into it. Like, how do assumable loans work?
Perfect. So like you just mentioned, the biggest part is that loan assumable? The way you'd find out is that servicer of the home loan. So the person that buyer is, or the person that owns the home, the owner of the home is making payments to. that servicer would be able to tell you if that loan is assumable, because like Kip said, not all loans are assumable. But in most cases, a lot of those government loans, FHA and VA are. So what it means is that buyer could essentially purchase that property at that agreed amount still, so whatever that listing agent or seller wants to sell it as, and then they can assume that loan as their mortgage and just use their down payment to make up the difference, right?
Okay.
And there's a couple caveats to it though too, because maybe that seller, let's just say the seller's selling their house at $500,000 and their assumable loan balance, what they owe on the house, is $450,000. So that buyer would assume that $450,000 loan, which is super low interest rate though. That's the key here.
Yep.
It's three times less what the market is, right? At that super low payment, and then they would just use their down payment of $50,000 like they were already going to use to purchase a home, and assume that mortgage and make the transaction work. So the seller's still selling it at their $500,000. Now the buyer's still getting a loan, but at a much better interest rate in the market. So it's a huge win-win, I think, for both parties.
So somebody could come in and assume a loan by just making up the difference in between whatever the house price, the purchase price, and the loan amount.
100%.
So if it's $500,000 purchase price and a $400,000 loan, they make up that difference. They can assume that loan and take over that seller's responsibilities to make those payments.
And it frees up the seller, right? Like now that loan is paid off essentially.
Yep.
And it's assumed by that buyer. Now that seller can go out and they can get a new home and get a new loan.
Yeah.
And there's one thing that's really cool about it though, is this. So you have the FHA like we talked about, assumable loans, but you also have VA. But this is something that's super cool about assumable loan and the VA, is that buyer does not have to be a veteran to assume a VA loan.
Yeah.
And how cool is that? I mean, because majority of all VA loans need to be for a veteran, right? It's a veteran loan. But a assumable VA loan allows for someone that's not a veteran to assume that loan. But as long as the loan can be assumed and that client qualifies, because it's another thing about it, you don't just get the loan, you still have to qualify as a buyer, right? Normal stuff, they're gonna check it.
But it's easier to qualify because you're not having to have that high payment. You don't have to qualify for this $4,000 payment, right? You can qualify for a $2,000 a month payment, and boom.
And who doesn't want that, dude?
Right.
That's a
Who doesn't
sweet
want to save
payment.
$2,000?
Absolutely.
Anyway, so super cool way to buy a house, be able to get a lower interest rate, and really save some money is the reason we're bringing this video to you. Hey, again, if you like this video, please like it. Please subscribe to my channel. I hope to be bringing you more stuff now, being at Keller Williams. I'm really trying to dive into my real estate videos again, and just bring you some good content. So, Casey, give your little spiel. Who are you with now?
Yeah, absolutely. I've been with New American Funding for quite some time now. I mean, we got some great products out there, but me and Kip will be putting out some videos to you guys. So find our contact information below, and we'll rock and roll.
Cool. Have a good day.